Hello and welcome to BQ Prime. A very good morning to all the viewers joining us on the show to discuss stocks and sectors that are moving. Today we have Amnish Aggarwal, Head of Research at Prabhudas Lilladher. Welcome to the show, Amnish, and a very good morning.
Good morning.
Amnish, my first question coming to you is with regards to the OMCs. On the action that we've seen by OPEC Plus, a surge of almost 8% was the immediate impact in terms of crude prices on the surprise output cut. In turn, if you see companies like ONGC, Oil India are in up move, HPCL is under pressure, BPCL is under pressure. What's your view and what would you recommend an investor to do?
You see, when it comes to both oil marketing as well as exploration companies, so they always tend to be volatile. For example, the current move of OPEC, whereby they will cut down on the production, it has already resulted in some spike in the prices of crude oil. Now, if you look at OMCs, particularly from the past 2-3 quarters, they have been actually incurring losses, mainly because of the, you can say, higher crude prices. They have not been able to pass on. So they actually, the marketing margins were on the negative side. So of late, they had turned positive and there were hopes that now these companies will be generating good amount of profits. Now with the increase in the prices of crude, I think the risk to their, you can say, turnaround in operations, more so on the marketing side, that emerge again. And that might be one reason that your oil refinery stocks, they are under pressure. So I believe that these stocks remain more or less like your trading stocks. So these are not like portfolio stocks in a given context because of the volatility in the crude prices, which remains from time to time. And I think maybe you can say this reaction both in your the movement in the stock prices, both for OMCs as well as the exploration companies. I think this is going to be a short-term phenomena. But yes, depending upon how the crude behaves in the coming few days, one can take the position. But these will be, in my view, more like you can say the trading opportunities and not like you can say long-term portfolio stocks.
Right, that's with regards to OMCs. Another interesting sector in today's session is the auto pack on the way the March auto sales numbers have panned out. Clearly, it's the two-wheelers at play, then moving to passenger vehicles and tractors overall seems to be slightly muted. What would your view be taking into consideration now that we have full year FY23 numbers? And accordingly, what should an investor do with auto names?
You see, FY23, if you look at, say, full year numbers, then they have come on a low base. So low base plus the shortage of semiconductor and other raw materials. So to that extent, if you look at, say, the full year growth numbers, so they will not give the right kind of picture. But if we look at, say, some of the trends which I can clearly draw out from this, one being that if you look at both in the passengers as well as in the two-wheelers, the companies which have been successful in launching good models on the electric vehicle side, be it Tata Motors in PV, be it TVS. So those segments, they have recorded very high rate of growth. And it shows that in the coming years, the importance of electric vehicles in the overall, you can say whether it is two-wheeler or PVs, that is going to increase. The second trend is that the March month in particular has remained muted for a number of companies. For example, if you look at, say, Maruti, if you look at their month-on-month numbers also, they were actually down around 10%. So the overall March month, I think it has gone very mixed for Maruti. It has been muted. Temo has done, or Tata Motors has done actually far better, led by electric vehicles. Similarly, if you look at, say, commercial vehicles also, while medium and heavy commercial vehicles have done well, LCVs have been under pressure. So I think it is very mixed kind of numbers. Some segments, particularly, I would say, utility vehicles have done well, EV has done well, MHCV has done well. Tractors have been more or less, I would say, flattish to muted. So it's very mixed back kind of numbers. And a lot will depend upon how the next 2 to 3 months go, how the current harvesting of crop happens, whether the demand goes up in the, particularly the rural India or not. I think these are some of the, you can say, factors which will determine the auto demand in the coming few months.
Right. So that's with regards to the auto pack. Now moving on, your HDFC Bank as well as ICICI Bank. Let's look at these two private banking names because clearly we are seeing an up move coming in terms of the banking sector. From a market perspective, participation and positivity was in terms of private banks is much higher as compared to PSUs. What would your view be with an HDFC bank as well as an ICICI bank?
You see, HDFC and ICICI in general and private banks in particular, they have been more in a consolidation zone from the past 2-3 quarters because the absolute returns have not come in these stocks. That is first factor which we need to look at. Secondly, the credit growth numbers, they have been reasonably well. So in general, people are looking at say 12 to 15% kind of a credit growth next year. Although the NIM expansion might peak out maybe say in a quarter or so. So in anticipation that the NIM expansion has peaked out, these stocks had gone into some sort of a sideways movement. But otherwise, whether it comes to you can say the quality of their assets in terms of the you can say NPAs or the profit growth, that has remained pretty healthy. But having said that, if the net interest margins they peak out in another quarter or two, then in FY24 we will not have the kind of profit growth these banks have shown in FY23. So due to that reason in particular, the stocks have been range bound for quite some time. But having said that, if we come now specific to HDFC Bank, I think HDFC Bank now with the merger having been cleared, I think it is only a matter of time before the you can say the stock shows some strength. Yes, it's a large cap stock. One can't expect it to give very big moves over the next say 3 to 6 months. But having said that, with the kind of consolidation which has happened in the last 12 months, I think one can easily expect around 15-18% returns over the next 1 year. Similarly, if you look at say ICICI banks in terms of growth, in terms of how the bank is positioned, technology platform, in terms of the overall, you can say the growth in the book size, NPAs, I think it is in the actually the pink of the health from the last say year or two. And all these banks, whether it is ICICI or HDFC, they are now trading at, although ICICI might not be, HDFC in particular, so their price to book is not like they used to be in the past. So the price to book has got corrected as the stocks had not moved up. So I think from here on, one can expect steady returns to come in these stocks. But I think on a very cautious note, like in the previous credit cycle, we had seen HDFC even trading at 3.5-4 times. We had seen some of the other banks going to that. So I think looking at the current juncture where the globally financials are not in a very good shape and in India the weightage for financials is pretty high. But post this consolidation, the stock should give you reasonably good returns over the next 6 to 12 months. But having said that, one should have very reasonable expectations as far as the price to book is concerned, because I don't think that in this cycle HDFC will go to say 3.5-4 times price to book, or an ICICI will go to 3 times price to book.
Right. So that's with regards to ICICI as well as HDFC Bank. Moving on from the consumption space, you have ITC as well as HUL, which are in focus now. ITC, in fact, after hitting life highs as well, we are seeing that uptrend that has continued. Overall, from a rural demand perspective, what would you advise an investor to do with an ITC as well as an HUL?
So you see, as far as your rural demand is concerned, I think the dependence of both ITC and HUL on rural demand that has actually come down over the years. Okay, in comparison to where it used to be, say for example, for HUL, where it used to be 10 years back, and now the numbers have come down. But having said that, there are a few select categories in rural, for example, maybe say biscuits or noodles or detergents, where there is seen some uptick in the demand, but the broader uptick in the rural demand is yet to materialize in most of the consumer categories. Now, as far as HUL is concerned, HUL has gained market share. Even if you look at past few quarters, their volume growth has been superior to the volume growth of most of the other companies in the sector. And now you will have the benefit of, you can say, some hope of uptick in the rural demand, as well as a tailwind from the moderation of raw materials. So the headline numbers for HUL, they should remain reasonably well. But having said that, the rural demand per se remains uncertain as of now, because the kind of rainfall and the kind of weather patterns which we are witnessing around the harvesting of the crop, that doesn't augur well for the rural incomes. And if that gets, you can say, some sort of the disruption is there in the, you can say, harvest, etc., then some broad-based increase in the rural demand that might get postponed for a while. The second one is your ITC. ITC actually has been riding on very broad-based recovery across its businesses. For example, cigarettes, we are close to, I think maybe in next year, we might touch lifetime high volumes, or rather, I can say we will cross the previous high because of, you can say, the market share gains which are coming from the smuggled, some crackdown on the smuggled as well as the illegal cigarettes, plus the relative, you can say, price stability from the last 3 years. So the cigarette business has done well. Hotels has actually just started witnessing an upturn after a long, you can say, winter from the last 10, 12 years. Paper margins have been lifetime high. So all the businesses of ITC have done really well last year. And I think given the fact that this year excise increase has been pretty moderate, that is one. And the second thing is that the growth rate in some of these businesses like FMCG more so on the margin side is going to improve. The medium-term outlook for ITC looks bright, more so given the fact that ITC still trades at less than 20 times the FY25 earnings. So the lower P multiples obviously give a protection to ITC, and given that it is even now trading at close to 3% dividend yield. So I think we are positive on, you can say, both the names. However, if you look at more in terms of the rural demand, I think that is one factor one needs to watch out for in the next couple of quarters at least.
Right. So that's with regards to the consumption side. Staying with this theme, what's your view on the consumer durables front, specifically taking into consideration that IMD is clearly forecasting a hotter summer this time? Do you think, companies like a Blue Star, Whirlpool would be good buy-on opportunities at current levels?
Okay, see, as far as durables is concerned, particularly the companies which we have referred to, which are more on the air conditioning, refrigeration, refrigerator side, so these are highly seasonal in nature. So for them, 1Q and 4Q and 1Q are the major quarters, 4Q from the viewpoint of inventory and 1Q from the viewpoint of sales. Now, as far as your weather patterns and IMD, your forecast is concerned, we are witnessing El Nino. And due to El Nino, not only in India, we are witnessing that in the parts of, say, your North America, Africa, and other continents also, there have been very volatile weather patterns. If you look at, say, last 15 days or a month or so, we had approximately 3 to 5% higher temperatures than normal in various parts of India. And then we are witnessing sporadic rains in, you can say, various parts of the country. Now, these kinds of weather patterns are obviously positive for these companies if we get a much hotter summer than what we usually do. Because the way things had started in the month of March, first 2 weeks were really hot. But after that, we had rains in the various parts of the country, which have cooled down temperatures a bit. Now, my sense is that for these companies, if we are having, say, the kind of temperature pattern which we had seen in, say, approximately last week of February or first 15 days of March, if that prevails, then it would be very positive for all the companies in the AC segment, including, say, Blue Star, Voltas, okay, or the companies which are into refrigerators. But having said that, I think next 1 quarter is going to be very crucial, particularly the next 2 to 3 months, because if the season pans out well, then I think these companies should do well from here on. But I think rest of the other factors like competitive intensity and all other one needs to also look at. But having said that, I think the last couple of weeks they have not been that great as per our channel checks, and so I think the situation is that of a cautious optimism, because as I said, if your temperatures remain high for the next 2 months, then you are home for the season, and if the temperatures moderate, you have intermittent rainfalls coming, because those 2 months actually make or mark the entire year for this.
Right. So I think a lot of movers and shakers that we are watching out for from a long-term perspective as well. Thank you, Amnish, so much for joining us on the show and giving us those views for the various sectors and stocks that we've discussed, because a lot of focus now is, in terms of counters that will help us inch higher from here on, because that's what the trajectory is looking like. Thank you. Stay safe and speak to you soon again.
Thank you.